This is Barry Knapp with Ironside's Macroeconomics. This video and audio summary will be released on Monday, September 20th. It's currently Sunday afternoon. S&Ps have just opened. They're down 11.5 handles, following through to the very soft close to last week. A couple of housekeeping items or things of note. One is I'll be in New York City next week during the Fed meeting, seeing a number of investors discussing the latest in policy and the market's outlook. And so hopefully my note will be filled with insights from those discussions next week. I'll do my best to get it out on Saturday morning as usual, but travel could interfere with that somewhat. The second item, some of you may have seen the Barron's story this weekend titled "September is Scary, but Worries About Stock Market Correction Are Overblown." I was quoted in it in a number of spots. Obviously, I didn't do a particularly good job convincing the author that a correction was probable. Ed Yardeni seemed to carry a little more sway on that. But anyway, there were 4 basic sections to our note this week. The first one was a discussion of what we were calling already a dubious growth scare. We never really thought there was much of a deceleration attributable to the Delta wave of the pandemic. We had our next section was a recap of the inflation numbers. We went on to then discuss tax policy. That is the title of this week's note. The bill comes due, and that's what we're referring to as the coming tax hikes. And then we wrote a section on China in light of the Evergrande real estate difficulties they're having over there. I hesitate to call it a crash, but well, let's go through this one section at a time. First, on the dubious growth scare, the obvious catalyst for us writing about that this week was the blowout August retail sales numbers. We've been saying for some time that the household sector was in almost the opposite position that they were in during the financial crisis. They have much lower levels of debt. Cash flow is exceptionally strong as a consequence of debt and the service on that debt that's so low. They also have high savings. Nominal wage growth is much stronger than it was back then and accelerating. And the demographics are different too. We didn't elaborate on that in our note, but we've been being told for years now that demographics are the reason that we have a lower natural rate of interest, so-called R-starred, and we had slower growth last decade. You need to keep in mind that these age cohorts are not all the same size, right? So there's 77 million boomers, 63 million Gen Zers, and 83 million millennials. For the last decade or so, boomers were saving, so maybe that did have some impact on the trend rate of growth. But they're now moving into their retirement ages where they start spending their savings. The Zers is the cohort that is now saving, and that's the smallest of those 3 main cohorts. And the millennials are in peak income earning part of this cycle, and that's the biggest cohort. So none of those things argue for weaker consumption on a go-forward basis. Additionally, that retail sales number, we expected it to be strong in part because we actually did have a back-to-school selling season this year. Some students are going back to school. In fact, most are. So that, according to one of our former colleagues, Bob Durbel, who we worked with at Lehman, Barclays, and Guggenheim, Bob's done a lot of work about how highly back-to-school sales are correlated to holiday sales. So that implies we're going to end the year with a very strong, consumption impulse or consumer spending impulse at the end of 2021. Again, that bodes well for the outlook. And in addition to the retail sales numbers, we also had very strong readings from the Philadelphia and Empire, New York Fed surveys, manufacturing surveys for September. So it looks like September's off to a pretty strong start as well. And when all's said and done, all these GDP forecast cuts we've seen are going to be sort of meaningless, and we'll probably see earnings come in better than expected. Again, we don't think strong enough to stop this stock market bleeding that's inevitable because of the policy tightening. So let's before we move on to discussing the inflation outlook, we did want to make the point that if the Fed does decide to take a pass on starting the tapering process this week, we think it's a policy mistake. And it's a mistake for the following reasons. One is, as we'll explain in a minute, the inflation risks are growing, not receding. Market positioning is pretty good right now for them doing it. Real rates are down fairly low. Fixed income vol is fairly low. So you're not going to move those to really excessive levels, even if you do have significant moves higher in them, as we would expect when the Fed stops buying 100% of the supply of tips and 100% of the supply of agency mortgage-backed securities. But equity vol is elevated. The entire VIX curve is up over 20 right now. Skew or downside puts are incredibly expensive. So that offers some degree of comfort as well, in as much as some investors at least are positioned for some downside here. Treasury supply is slowing, so fewer Fed purchases shouldn't cause as much of a hiccup. They don't really want to push this to the end of the year and run into year-end financing. Now, I realize US banks are flush with cash, but European banks have different rules. They're big players in the market. Just doesn't make sense to start slowing asset purchases at the very end of the year. And because of these rising inflation risks, if they wait, they could wind up having to do this much faster than they would otherwise like to, and could get forced to accelerate the process through the first half of 2022, and that could cause a bigger disruption. So let's move on and discuss the inflation numbers that we saw. So the first part of the story, the one that Team Transitory is so fixated on, is the impact of the Delta variant on some of the reopening sectors. And you saw used car prices falling, lodging prices falling, car rental prices falling, and airfares, which are going to be under political pressure throughout the cycle, all falling. But those are up considerably this year, some as much as 50% year on year. So, okay, gain a little comfort from the fact that the reopening surge is over. But then if you move on and you look at supply chains, and you see new car prices up and headed higher, furniture prices up and headed higher, appliances, sporting goods, and even televisions, which have been falling seemingly for my entire lifetime, those are rising for the first time in, like I said, my entire lifetime. So those all relate to the supply chains, and there doesn't seem to be any easing going on there. And then we have what we've been calling the dead weight sectors. That is housing, education, and medical care. And the housing numbers still look screwy balooey, for lack of a better term. Rents, when we put a chart in the note, are surging, yet the rental equivalent in the CPI report is barely edging up. House prices are surging. Again, those shelter measures are at 3%. That's just nonsensical. That net measure will undoubtedly get restructured somewhere down the way. And then medical care prices have gone up the last couple of months. We expect that to continue and gain some further momentum. And finally, education prices are also negatively contributing. All three of those sectors are below the aggregates right now. That's not going to persist. Those have been big drivers for decades. Yes, we think their productivity is going to come to those sectors, and those sectors will be better over time. But house prices and the rental equivalents, those will be 4% and 5% in no time, and probably persist for some period of time. Any Fed official looking at that seriously has to think that those measures are just off. And then one final point about the longer term inflation outlook. We had a big disinflationary shock from energy prices last cycle because of the shale technology revolution. That is unlikely to be repeated next cycle. There's political measures around it, ESG pressures, but these companies have now moved into a point where the elasticity of supply is much greater. We expect a much more stable and higher return on invested capital. That's why we're overweight energy, but it also means a higher and more stable price and no more booms and busts like we've been getting in energy for 5 decades. That's what shale really will ultimately do. Yeah, could we move, could prices move up $20 or $30 in a relatively short period of time before the adjustment takes place? Yes, but it takes 3 weeks to drill a shale well, 3 years to drill one in the Gulf, roughly. So that's our idea there. So you're not going to get that disinflationary shock from energy either. All these things point to much higher inflation risk and the Fed wanting to get on with their policy normalization. That's it on inflation. Moving on to the bill coming due. The tax plan getting pushed out of Richie Neal's House Ways and Means Committee is bigger than we thought. The pressure from people like Joe Manchin and Kristen Semina to pay for all the spending means that the tax hikes could wind up being bigger than expected. And there is no question that these are fiscal tightening from the perspective of equity investors and investors in general. And so we won't get too deep in the weeds on each of the provisions because it still needs to go through the process, although it's an expedited process. But this is clearly a negative. International tax provisions started to show up in weaker performance of big cap tech. The drug price controls that they're discussing, 500 billion worth. This is crazy time. It's like Nixon all over, and that showed in the big pharma stocks last week as well. So the market is starting to get nervous about this. If we had to put our finger on any real source of or primary source of the weakness last week, yeah, there was a marginal increase in the probability of a Sept taper based upon movement in real rates and the flattening of the long end of the Treasury curve, but it looked like taxes were beginning to trouble the market as well. One final point here on the debt ceiling. We do think there's a pretty good chance for a government shutdown, albeit a brief one. And we go back, in the note, we went back and we discussed 95, 96, and then 2013. This did not hurt the Republican Party, despite the press trying to pin it on Republicans in both cases. So in 1995, 96, Bob Dole, the Senate Majority Leader, broke the impasse. That basically led him to get the party's nomination for presidency to run against Clinton, and he got steamrolled. He was not a hero as a consequence of that. And the Republicans did not lose their majority in the House or Senate. This did not help the Democrats all that much. The Republicans maintained control. And then the case in 2013 was even more significant in as much as the Republicans captured a whole bunch of House seats, captured a number of Senate seats, took total control of the government after that shutdown. And so it didn't hurt them one bit, again, with the press trying their hardest to pin the whole thing on the nasty Republicans and Mitch McConnell and everyone else. So I don't see the Republicans' incentive here to fold and respond to Janet Yellen's editorial in this morning's Wall Street Journal, say, yeah, you're right, we should do this. The Democrats are going to have to do it themselves. They're going to have to add it to the reconciliation bill, I suspect, in order to get this done. Or there is another maneuver they can do to push it through, but it's going to have to be Democrats that do it. There's no real incentives for Republicans to say, you spent the money, yeah, we'll just raise the debt ceiling for you. So that's it on that. It's not a catastrophic thing. What Janet Yellen described in the Wall Street Journal today about it causing a recession is nonsense, but we'll just move on from that. Finally, we had some pretty negative comments about China. There's nothing that would convince us at this point to put any money to work in China, but we do not think Evergrande is Lehman Brothers. Lehman Brothers went down because Hank Paulson made a political decision. He received an incredible amount of heat for the Bear Stearns deal when they took $30 billion of mortgage assets, had BlackRock manage those assets, and then gave the rest of the company to JP Morgan at a bargain basement price. The next one that came along, he was determined to send them into bankruptcy. He made a decision between Lehman and Merrill. I was a Lehman managing director, as most of you know, and he did not open up the primary dealer credit facility when they expanded the collateral to us. 19 other banks got access, we didn't, and that's why we went down. It was a purely political decision. China's a closed capital account system. They're not going to have that kind of a run on their capital markets and on their funding. But I think you could make an argument that their real estate assets, the quality of their assets are much worse than was the case in the US. We hadn't done that level of building like the Chinese did. We certainly didn't have empty cities. So, the Chinese system has been so reliant on real estate for so long, local government financing vehicles and the like. A third of the revenues of local governments came from land sales. They probably need to convert to property taxes. Maybe they'll get there eventually, but this is a big drag on Chinese growth. And this is being done for control reasons, not for any real economic reasons. These arguments that they're trying to make a more just, fair economy, that's top-down central planning. It won't work. Just as I said, there's nothing that could convince me that you should be putting money to work in China anytime soon. So that's it on all that. Should be a very interesting week with the Fed meeting. Again, as I said, if they take a pass, it's a mistake. If they go forward, the correction is inevitable, but but be prepared, because if we do get a good flush and we're down, 10+%, then I really strongly suggest you start putting some money to work. I do think it's coming, but I do think it'll be a buying opportunity. That's it for me. If you're not already a subscriber to our full research notes, I'd love you to become one. If you're a institutional investor who has a voting system, please, I'd love you to onboard me. And if you pay for research with commissions, then you can contact me about my relationship with Macro Risk Advisors. That's who's hosting the dinner that I'm doing this week. Great guys, great shop. And I hope everyone has a good week, and good luck trading.